and welcome to this very special series, Currency Options, Manage Your Foreign Exchange. The world is governed global. Your fortune sitting in India can change when there has been an interest rate hike or an inflation scare in another country because our currency has changed its value. Corporates, SMEs, all of them have exposure to foreign exchange and they want to hedge it. Traders, retail, they've all gotten savvy and they have a view on the market and they want to play it. But how does one go about it? Well, folks, we have some good news for you. Currency options, the latest instrument being introduced by the RBI and the SEBI to manage your foreign exchange. But what are currency options? What's the market like? What's the advantage? What's the disadvantage? All the nuances related to currency options coming up for you in the next few weeks. But more importantly, how do we make them work for you? NSE and CNBC TV 18 present Currency Options, Manage Your Foreign Exchange. But before anything else, let's give you a quick heads up on what currency options are. An option contract is defined as a right but not an obligation to buy or sell an underlying asset at a predetermined price at a specified time. Main advantage, upside unlimited, downside limited. To explain with an example, a buyer and seller enter into a specified contract. The contract is to buy USD INR at 47 rupees. This is the strike price, contract expiration, end of the month, contract size for $1,000. The buyer pays the seller an option premium of 0.33 rupees per dollar. This is paid upfront. Now at expiration, case 1, if the price moves to 48.5, the buyer benefits since the spot is more than the strike. He makes 1.5 rupees on the contract. His net payoff stands at 1.5 rupees that he made on the contract minus the 0.33 he spent to buy the option. The net profit stands at 1.17 per dollar, and for the entire contract it would stand at 1,170. Case 2. USD INR falls to 46.5. In this case, the buyer loses since the spot is lower than the strike. Such a case, you let the contract expire and the buyer's loss is always capped at 0.33. On the entire contract, 330 rupees. Case 3. It falls even further. USD INR stands at 45 rupees. The buyer's loss continues to remain capped at 330 rupees. He lets the contract lapse. As the graph explains, for the buyer of the contract, the loss is limited while the gains are unlimited. So that's the basic about currency options, but it's a new product, it's picking up in pace, there's a lot to learn and understand about it. Joining us today is a very special guest, Mr. AV Rajwade, one of the most expert and respected voices in the foreign exchange space, and he's also the author of a couple of books now, the recent ones being Cash and Derivative Markets in Foreign Exchange and Currency Exposure and Derivatives, a Corporate Treasurer's Handbook. Mr. Rajwade, many thanks for joining us and taking the time out to speak with us. In your career, which has spanned decades, you've seen the growth of the entire foreign exchange, right from OTC to exchange-traded products like futures and now options being introduced. What's your view on currency options as an instrument?
I think it's an extremely useful product. In fact, my grouse is that the corporate world is not using it as much as it really should be, because options have a great deal of advantages over the traditional forward or the futures market, because you can benefit from a favorable price movement while under a forward. In fact, I compare a forward contract or a futures contract like a Hindu marriage. Once you have done those Sat Feras around the Homakunda, there are no options left. So if you have any more attractive price opportunities, you can't take advantage of that. While under an option, you pay a fee upfront for buying that option, and then you are protected against an adverse movement, but you can benefit if the price movement is in your favor. So I think options are like insurance. You pay a fee, buy protection. If that event happens, you are completely protected. If it doesn't happen, good luck to you.
So what are the key advantages that an option provides vis-a-vis something in an OTC market, and also if you compare it with the futures?
No, I think these two are different comparisons. One comparison is between OTC and exchange-traded options. The biggest advantage of exchange-traded products, as distinct from the OTC products, is that the pricing is transparent, in the sense that the price is available to you on the NSE screen. That is the price at which everybody can buy or sell that particular contract. On the other hand, in the OTC market, at a given point of time, the trader may quote different prices to different players, depending on various things which I won't go into. But the big advantage, in fact, in certain ways, OTC markets are like unlisted securities, while traded derivatives are like traded equities. So the price transparency is one major advantage. The second major advantage is that to achieve that price transparency, exchange traded products necessarily need to be what are known as plain vanilla, simple products. While in the OTC market, the banks market a huge amount of structured products, and you might have come across, there have been so many cases in India, in Korea, in many other countries of companies making huge losses on structured products which they did not understand and which they got sold by the banks. Banks have excellent marketing teams, and they suffered losses. I mean, a very large number of companies in India have suffered major losses. The third is that they are mark to market every day. So every day you know whether you are making money or losing money on that particular product. Unlike an OTC product where you will need to ask the mark to market valuation, you may not get it from the bank on its own.
But what about an option vis-a-vis a future? Because all the advantages which you listed were primarily on account of both these products being exchange traded.
Both are exchange traded products. The difference is that a future is a standardized version of a forward contract. So therefore, as I said, there is a right and obligation on both sides. So therefore, futures contracts can have opportunity costs. Yes, you are locking into a price, but if the price moves in your favor, then you cannot take advantage. Because you are locked into a particular price. It's a right and an obligation. While as far as options are concerned, they create a right in favor of the buyer, but the buyer has no obligation to complete the transaction. So therefore, if the price has moved in the buyer's favor, he can take advantage of the price. So one has opportunity costs, because you can miss out on a good opportunity. And opportunity costs by definition are unknown. The other one has an upfront cost, which is known in front. And that's why I personally believe that options are in many ways a safer instrument for hedging. They are very comparable to insurance policies with which we are all familiar. You need to weigh an opportunity cost which is unknown but which can be there against an upfront cost which is known right at the start.